Good morning, welcome to the market view for Wednesday the 28th of May 2014. And starting off with the 30-minute chart, we can see we had a sell signal just after 9:30 there, and the order wasn't filled until half an hour later. So let's just mark up this trade. You will see that I'll put it on the right bar, of course. You can see there the market filling this around the 10 o'clock time and then moving lower through to the scalp and then finding support at the S2 there. We have a green candle here. If you wanted to hold the trade in the longer term, then you are looking at 50% above the first green candle there. We've got another green candle there, which of course will be higher, as you can see there. Another green candle later on in the afternoon, and the market into the evening around 6 p.m. there, followed by a green candle, and then eventually the market coming back and stopping the trade out and retracing back to the 168 level there. So around 58 points, I would think that is on this particular trade. Let's just have a quick look from there to there, ballpark 58 points, and of course from the sort of the maximum on the trade was 71 pips there. So a good day yesterday. I'm quite happy with days like that and can live with those sorts of trading days every day. They certainly make life a lot easier. So the market's bounced back above the 168 and has been like that on the overnight. In the 60-minute chart, same thing there. You can see the market moving lower there and trading down to the same area, of course, and then bouncing a bit there. In the daily chart, we can see why the market stopped where it did yesterday. I'm just going to remove a few lines, just get rid of this extension. I'm going to keep this one in at the moment because it's near the 167.50 area, 61 there. So we go back to markup, annotations, and then fib extensions. If we worked our way down from the highs, taking each low, the last one we've got is from here up to here, and you can see we go down towards the 76% retracement. 167.76 is where you'd expect to find some support, and if we just have a look at the low for yesterday, 167.81, so 4 pips off the figure that would have been provided from the daily chart. Now that I've finished the implied volatility chart, this is the next thing I'm going to concentrate on. I'm going to show you how to really get into the nuts and bolts of the fib retracement tool and how to draw these on the chart so you can again predict where the market is likely to stop, where it's likely to trade to, and so on and so forth. And also eventually when we get to some more sophisticated, I suppose, it's not advanced but just a bit more sophisticated, is I'll show you how to use it across time frames so you will see precisely where the market will stop. So that's where yesterday traded to, and that's the reason there. Today, let's have a look. We've got, obviously this is going to be relevant still, so if the market moves lower, 167.76 is going to be an important area. We're going to have 167.76 here, and then of course we've got the 167.50 and then the low of this bar as well, which is 167.30 as well. That's where the market found support before we had this move back up into the 62.76% area. So if the market is going to move back up today, the only bar we can actually get some idea initially is going to be this one. So I'm just going to click twice and do that above, not below. I'll get used to this at some point. That's it. So we want twice there, and that 2 clicks on one bar will give me 76% of the range back, because I haven't got any other high or low to actually mark off unless I want to go back to this one, which I would do if this 76% is taken out. So on the upside, that's where I'm looking at, and I can only use that one bar. And again, I'll explain this more when I actually record the video on Fibonacci, so you can read the cycles in the market, how it oscillates between these sort of natural areas of support and resistance. So that's where we can expect the market to trade to. On the downside, we've already more or less covered, and of course, if you wanted to, you could actually go as I did before, just twice below, and you can see the market's currently trading at that anyway. So the market already on the 168.05 level, which is just there. So again, no surprise really that the market's finding support there. Then you've got the 168 level below, and so on. So a quick look at the news before I bring something else to your attention. We've only got medium impact news items today, so no big deal there at all. So there's no point in staying there with the news. It's all European, and there's only some GDP news at 11 a.m. CBI realised sales there, so you can ignore that. Implied volatility, if you've not seen the video, then go and have a look at it on the website. It's under the training tab, under the video there, Dow implied. We are setting up for a historical precedent here for the implied volatility. It's perfect timing as far as recording this is concerned. Watch the video, then you will understand the rules behind it, and you'll understand why I'm excited about what we've got at the moment. The code for the Dow is DJX at optionsvolatility.com, and then you will find the charts on the right hand side. If I just let me just reduce this a bit. So I was trying to make it easier, but it's probably confusing it a bit, so let me just bring the zoom back a bit there. So let me just type in DJX until you get used to this. And then if we scroll down on the right, you will see two charts. One is the price chart, and then the implied volatility, and it's the implied volatility that we are interested in. Friday, the market put in a brand new low. Anything below 10% in the implied volatility in the Dow, expect a correction in the market. Now, what was interesting yesterday is that the market actually kicked up a bit, even though on the implied, even though the market actually moved higher. So this is an interesting picture here. So maybe we are on the verge of a correction coming into this market. So you can see the options starting to become a bit more expensive yesterday, where I was hoping that they would have forced it down to a record low, well, a new record low, because at 902 is already into record lows. I don't think I've seen it below this, which you can see in the last year. It's not been anywhere near this. These are the spikes or the other corrections that we've had in the Dow. So we are due for a pullback in the Dow Jones there. Another one that I want to bring to your attention as well, and it's out of favour at the moment, and that's the gold and silver market. And the code for that, this is an interesting one, is XAU. And I didn't know about this until rooting around yesterday and talking to a trading friend who lives abroad, and we were talking about gold and silver, and he said that the implied had actually doubled, and I said, where'd you get the code from? And he said it's from here. And what they do here, let me just show you this chart first. This is the price chart, and this is a metals index for silver and gold, and you can see that the index has actually been dropping. So the underlying market, silver and gold, have been dropping since March. It's come down from 105 to 85. The price has dropped there on the index, and in the implied chart you can see we've had this this drop off as well, all the way down to 20. A bit well, actually it's probably not far off 100% decrease in this market from March, certainly April there. So a bit more on the downside there for gold and silver, but again, it could be a great setup for a move in the gold and silver market, because certainly these markets have been trading in a sideways range over the last few months, and that's why the volatility is dropping off. So you end up with a situation where you get a pullback of nearly 100% on the implied, plus the historic lows in these as well. So again, an interesting one to keep an eye on as far as implied volatility is concerned. We're at the lows as far as this is concerned. 23. Let me just move this over. 23rd of May again as well for this one. The high was in July 08 at 47. So it's been a while coming. But we're seeing a major pullback in the gold and silver market again, which is consistent with these markets breaking out to the upside. So I thought I'd just throw that one into the market view for you as well. So just to summarise then, as far as Dow implied down at historic lows below 10%, expect a correction anytime soon. Gold and silver also expect to move to the upside in these, with the volatility pulling back to these historic lows as well. I can't pinpoint the date or the time, unfortunately, with this. This is rule number 1 if you've watched the video. We just have to work with what the market does and then take a position thereafter. But once it's achieved its objective and we move to rule 2, then we can actually time the trade better to actually reverse the position. But until that happens, I can give you no more as far as rule 1 is concerned on the timing of these events when the market will take off. Nobody knows. It will just happen when it happens. Right, well, that's enough from me this morning. I will speak to you tomorrow, all things being equal. Have a great day. As ever, thank you for your support and all of your kind comments with regards to the implied volatility video. It's very generous of you. As ever, thanks for watching, and see you tomorrow.